Welcome to the Dividend Talk podcast, episode 120, quarter three earnings. Hey guys, welcome back to another episode of Dividend Talk. Today we're going to talk about earnings from Europe and the US. We also have a portfolio review and we'll talk about some dividend hikes that has happened in our community. All that and more. See you on the inside. Good morning, European DJ. How are you on Saturday morning?
Really, really good. And by the way, happy Halloween to you. I don't know how they celebrate it in Ireland, but I'm really looking forward for this long weekend here in Poland. Tuesday is a bank holiday. Not sure if you've ever seen that, but here everyone will go to the graveyards massively. It's like queues with cars. You hardly can reach it. And then hundreds of thousands of people on the graveyards, lighting candles. And then, when you go there at 5, 6 in the evening when it's dark, it's beautiful. Like you go to this massive, large graveyard where some of our family members are, and it's fully lighted up with candles. It's beautiful.
Wow, we celebrated on Monday, so Monday's our bank holiday, and it's completely different. It's actually different now than when I was growing up. When I was growing up, we used to have bonfires, so you build huge bonfires. So you spend, as a kid, I would have spent all of October collecting pallets, collecting tires, and we'd build a huge bonfire. Health and safety has put a dampener on all that kind of stuff, so it doesn't happen as often at all. Actually, you're not allowed to do it, and where you are allowed to do it, it's more controlled. But kids dress up. I don't know if they do that over there. They all put on their scary costumes, and they all have them in school on Friday. It's the last day of school before they have a week off, so they dress up on Friday. They dress up again on Monday. They go around and they get the amount of candy and sweets they will get on Monday is ridiculous. I mean, it lasts them for about 2 months, but it's always good. It's always good fun. It's a good time of year. Lots of fireworks going off, but exciting. But it's interesting to hear you guys celebrated more on the Tuesday than the Monday, which is because Halloween is on the Monday.
Yes, exactly. So it's more on the Tuesday, but our kids also, it's nowadays becoming a habit, I believe. I don't know how it was in the past here because I didn't live here, but our kids also, they're already like, full of energy to, they were already asking like, oh, can our friends come? We'll go to the streets, and then later I'll go to their neighborhood and we'll collect candies there. And it's like really like how to build a candy business.
Yeah, it's crazy. So my kids they'll go down where we live. They go down to my parents where they live, and down to my wife's parents as well. So they have three kind of areas, and they will get about 2 or 3 full bags of sweets that they just come home, empty it all out, throw out what they don't like, and not throw it out. They'll give it to someone, but they never even eat. They never even eat it all. There's just too much stuff. I mean, it's crazy.
Talking about these nice candies, maybe let's talk a bit about the dividend hikes. So what I wanted to just list is a few of the dividend hikes that we had this week. First of all, Rockwell Automation, ticker symbol ROK, hiked the dividend by 5.4%, not beating inflation. But what about Visa? Hikes the dividend by 20% to 45 cents per share quarterly. Upfee by 5%. It's already a high dividend payer, right? From $1.41 to $1.48. ExxonMobil 3.4%. I mean, Exxon is a bit conservative lately, and I think they mainly did this dividend hike based on the share buybacks. Yeah. So probably a flat dividend. And Shell announced a 15% dividend hike for the fourth quarter, subject to board approval. We don't know yet the exact number. But never sell Shell. So, talking about Halloween, we have got 5 awesome dividend hikes here.
Yeah, I mean, Rockwell Automation is not a company we speak too much about on this show, but it's a company close to my heart. I use their products quite a bit, particularly in programming PLCs. It's probably the first how would I say, programming language that I've ever used, so that the software is super easy. So if you use American products, American machinery, they will always come with Rockwell. They will always come with Rockwell. If you go out to Germany, they will come with Siemens. Both really good products, but if you want to compare them on which one is easier to use, more friendly, even better customer service, Rockwell wins 9 times out of 10. They are just
Nice.
incredible. I found a bug once in one of their patches. It was a
Mhm.
really rare bug, but I got onto their customer support and they had a patch and a fix within 3 days. It was incredible.
Nice.
So
Nice.
I've never got that with anyone else, but it's a super company. I don't know. Actually, I've never actually dug into the financials, so I don't know what they're like to invest in. But as a company, they're a super company. But yeah,
Well, you're the engineer my freedom, so some expectations there now,
I
Derek.
know, I know. I have to add them. I have to add them to my list. I'm actually going to add them. I have my automation Pi, which I have
Yeah,
Schneider. I have Cognex and companies like that. But I want to add
yeah,
these guys that are there, and maybe I'll start talking about them a little bit more.
cool.
Um, well, we had a cool week this week. We had Dividend Day, which was
Yes,
on Thursday.
Thursday.
Actually, feels like it was actually so long ago. It was only 2 days ago, but that was quite cool. We always do the Intel earnings. Amazon and Facebook were out that day as well, I believe.
Yeah, yeah.
And I mean, everybody was expecting. I don't know what they were expecting, but those two guys dropped really hard.
Well, Amazon, what was it? 20% down. Meta as well. What was 25% down? It seems a little bit like that now. The big tech, are getting hammered, right? We saw it already with the growth shite stocks from all those things you see in the ARK Innovation Fund, and now it's really coming to big tech. But I do feel that this is like, if you think about Amazon, for instance, it really feels also a little bit like consumer-led or recession-led. That these are kind of the recession symptoms that are
Yeah,
coming up. But Meta is just plain stupidity. I mean, I own Meta, right? Full disclosure, I bought them several years ago at 150. I felt like a king for the last 3 years. I held on to them, and then with the metaverse, I thought like, interesting, interesting. They have enough cash flow. Let's see if they can pull this off. But I'm now at the state that I think like, what the fuck is this Zuckerberg doing? I mean, you also need to take feedback from the industry, and I understand he's pioneering, but he's throwing so much cash to it that he could also take another approach. Just be a bit less aggressive, keep a healthy earnings to satisfy shareholders. And if there is a competitor, do like Instagram, just buy them quick enough.
yeah.
You can still do this. So I think he's not smart here, and he's just really throwing away our investors' money. So I need to reassess whether I want to keep Meta or not.
Has it got to a stage where he's been so successful? Anything he has done before has kind of turned to gold. He had that bit of a touch about him. He thought he was invincible. I throw this amount of money and I can literally change the world. And he's
Yeah.
just trying to. I think he's trying to ram it down people's throats. Like even having, I know people working there and they sit there and they have their meetings with these
Mhm.
Oculuses on them and stuff like that. He's just trying to. I think he's trying to force it, whereas Facebook came more natural.
Yes.
It was
Yes.
more of a
Exactly.
natural progression.
Yeah.
And I think the more you force it, the more maybe people might
You
go
know,
away from it.
I wonder what he is also doing. He's trying to go quicker through the innovation curve with this technology, right? And I wonder, is really someone like Meta, a company, are they really the ones that need to do this? Why don't you just partner with a university and you leave it with the university? They do the research. You provide grants and everything, and then you maybe share in the intellectual property rights.
Yeah,
It will take a
yeah,
bit slower. I think the world can wait another 10 years. I mean, we've had Second Life. It's not like the world went down after that all collapsed. So this is my issue with the investment case here. I do believe there's a value in the metaverse. Not sure if it's good for humanity, but I do believe there is a business case for it. But Facebook, he could do it from his basement by building a website and coding.
yeah,
Here he needs to invest in technology, and he really needs to push the boundaries of technology, and that comes with such a high upfront investments. it's almost like he's pulling off an ASML, right? With the risk behind it.
Investment in risk. Facebook was no risk. You make it from a
Exactly.
bedroom, no money, no
Yeah.
risk, and now you're taking a hell of a lot of risk, and you can understand why investors are running away in droves at the moment, because
Yeah.
it seems quite scary. But are we starting to see now big tech starting to capitulate a little bit, and maybe that will signal maybe the bottom of this
Yeah.
curve, and we might start to turn a corner. Who knows?
Yeah, I also don't know. It's all part of my 10% portfolio. Amazon I never owned, although I like it as a business really much.
Yeah,
So, but I want to focus more on dividend stocks now. I've still have Alibaba with an average cost of 150 that's now trading at 60. Meta
yeah,
as well. So I'm feeling the pain there. And it's also, again, a nice lesson of how well protected, how well dividend payers do, during
yeah.
these times. Look at Johnson & Johnson. It went nowhere. Texas Instruments is still nicely here, right?
I
It's
mean,
really
we
the
we
safety
got
net.
we got a lot of feedback, didn't we? Get a lot of people asking us why we don't invest in certain stocks during that growth phase. We had people come on the show talking about it, and part of us we're saying we different psychology. We don't know when to sell. A lot of those people didn't sell at those highs because they felt like they would go up and up forever.
And I had the
Yes,
same
as
with
they,
Meta. I
yeah,
didn't sell after it doubled. Well, my rule said sell half if it doubles and play with the house's money. Yeah,
but
and I didn't do it.
as dividend growth investors, yes, we did not double our money overnight or in a 3 month period, but we were growing steadily. But the upside is now we're in a bit of a bear market, and my dividend portfolio is actually holding up quite well. It's the other
Yes.
shite that I'm doing that is suffering. But actually, my dividend portfolio is, I don't even know if that's even at a loss at the moment. So
Yeah.
I mean, I think we have a good reference point now that maybe in 3 or 4 years, when people forget, because people generally forget the
Yeah.
past when they jump on the next GameStop or whatever, we can always point back to this and say, well, hold on, you lost 100K, and this time you've had to try and build that back up, whereas we kept it
Yeah. And the
steady. So
dividends keep on growing in the same time.
look at Shell.
Yeah.
So hey,
Exactly.
let's move on to Europe. There's more talks of rate hikes. They're starting to talk a little bit more in Ireland about mortgage hikes going back up again. A lot of people are talking about it. That's obviously, they're trying to put pressure on the market. House price over here inflated. People can't get in and buy new houses because the rules around, you need to have. So I don't know what it's like in Poland, but in Ireland, after the financial crash and the Celtic Tiger crash, the rules tightened up a little bit. So you had to have a certain amount of money built up before you could buy a house, and
Yeah.
then the house that you could buy would depend on what you earned. So if you earned fifty
Yeah.
thousand, you could only buy a house, say 200,000, so 4 times the
Yeah.
amount. Obviously now prices going up, people's wages are still staying the same. So if that same person's is 50,000, house prices now average say 300,000. The
Yeah.
bank won't give you the money because you're overextended unless you save up more of a deposit. So you would have to have maybe 100 and maybe about 100K saved up, which is not
Yeah.
possible for lots of people. So it's creating a bit of a deadlock over here. I know the markets are trying to ease those rules a little bit, but now we have talks of rate hikes, mortgages going up, and there'll
Yeah.
be all sorts of panic. I just know this from my wife. My wife said it to me. First thing she said it to me, I came home maybe on Wednesday. She said, "Oh, they're putting up the mortgage again." I was like, "Oh, great."
Yeah, so I don't really know how it's here. I just know German inflation is also 10% year over year. ECB
Yeah,
now hiking the rate with 75 basis points to 1.5%. No, we haven't seen this since the great financial recession in 2009, right?
yeah,
These hikes, and still just 1.5%. I mean, these are unprecedented times. Like every recession is a little bit different. Every crash is a little bit different. I think we're having here a slow crash, but it was similar in 2007, 2008. I remember it started, and then suddenly, after I believe after 9 months, came the real crash. So it was like lowering for 9 months, and then boom.
yeah.
Yeah, I don't know
Uh,
if we will see something similar here, but yeah, it might be. Yeah,
yeah, I was just about to say that. I mean, I know there's pain out there, but I don't see as much pain on the streets as I did back in the last financial.
exactly,
I
exactly.
don't. I don't, and I felt it myself back then. So maybe I was more in tune. I'm a little bit more
Yeah,
protected this time around, but I just don't see it as bad yet. And I'm waiting for that moment
yeah,
where, because it usually does, don't it? It usually just falls off a cliff and then,
yeah. But we're starting to see that in the news now, right? In America, they are already firing a lot of people in big tech. Yeah, as an example, Intel as well, lots of cost cutting. So I wouldn't be surprised if this will start soon with the earnings. Yeah, and if the margins need to be retained and they don't have pricing power, they will look at the cost part of it. Yeah, yeah, yeah. Well, anyway, maybe this is also a nice time to go to the earnings. What do you think?
yeah, let's go. Let's start with one you've mentioned in the dividend hikes, which was AbbVie. We know that they've increased their dividend by 5%, which is good. Technically, they're a dividend aristocrat because they were part of Abbott, so it's nice to see them continue that on. Looking at their earnings, again, the reliance on Humira is quite strong. There's nothing even coming close to it. It is encouraging to see the likes of Skyrizi and Rinvoq, which are our two newest products. They are doing really, really well. Skyrizi grew 75%. It's now 1.3 billion this quarter. And Rinvoq is grew 53, but that's only 600 million. So even though Skyrizi is now their second biggest product overall, it's still not even touching Humira. So that's a it's a big flag sometimes, but on the other side of it, global Humira sales have grown over 2.5% this quarter as well. So there's still, I know there's risk there, but they're still trying to grow it. We did say before that uh, it doesn't just fall off a cliff straight away. There'll be a gradual decline. And if they can continue to bring out products and if they can continue to do what they've done with Skyrizi and get other products out there that match that, then they might not be in too bad of a place. Revenues were up overall, which is good. Earnings per share is up, and they increased their dividends as well. So, look, it's I wouldn't say it's a blockbuster quarter. I wouldn't say it's a bad quarter. It's kind of middle of the road. It's nice to see that the new products are doing well. It's also nice to see Humira are doing well. It seems like all their portfolios seem to be growing slightly, apart from hematology. I can't even pronounce that, but some oncology portfolio has decreased, but all the rest of them seem to be doing quite steady. So it was a good steady earnings from AbbVie. Um, I'm a shareholder. I know you're a shareholder. I would just like to see something similar to. I compare these to Roche and I see what Roche are doing. And Roche had a reliance on three drugs, and they've scaled quite quickly the portfolio, so it's not as skewed. I would like to see AbbVie doing something like that. That's what I
Yeah.
would like to see. Just take that a little bit more of that approach. But look, there's no real concerns for me in the immediate future or anything like that. Cash flow seems safe. Dividend, which they've raised, obviously is going to be safe for another while. So no, all good.
And have you had a chance to look into their how is it, their balance sheet, or they release their 10K usually a little bit later, right?
Yeah, a little bit later they released that, so that their balance sheet wasn't on the earnings. But I don't know if it's
No,
out yet. Actually, I checked this the yesterday, but it could be out last night.
yeah, usually the 10K comes a week later or something like that. So, uh,
I don't know why they do that. That really annoys me, by the way.
yeah, yes, but maybe it shows how the admin department works there.
They need no admin. Yeah, just
Yeah.
give me everything when you release the statement, please. Thank you.
Yes,
That's all I ask
exactly.
for.
Nice one. I mean, I just, for me, it's most important what you just mentioned. Like, is the portfolio diversifying and therefore the revenue kind of stable? We do expect a bit of a revenue cliff, right? Which is fine, but most important for me, therefore, the second one is their debt declining? And yeah, I need to wait a few days for that before we have that answer. Good one. And I just checked. I have almost a 10% yield on cost on this little baby here. So it's
Wow.
one of my best
Nice.
performing investments that I did. And yeah, what is really interesting with that is that I can, for instance, just this one tripled in price for me, almost. If you take the dollar euro currency into it as well, and then you can have like 2 or 3 or 4 other bad investments, yeah, because they don't go to zero. Those bad investments, maybe 20% down, but still, AbbVie makes up for all the losses there. If you look at it from a price point of view. So it's doing me well, doing me really well.
Good,
But you know,
good.
and
All that matters is that they keep cash flow stable, paying down their debt, and giving us those
exactly,
dividends. That's what
exactly, and
matters.
they know what we need as dividend investors. And speaking of which, let's talk about Shell. I mean, they had a really strong quarter again, and what I really liked actually is that their cash flow from operations continue to do well. But this quarter looked a little bit different now because, for instance, their cash flow from operations for integrated gas was 6.6 billion. And just think about these numbers, right? 6.6 billion. Upstream, which is like really the pumping up the oil and the gas, 8.3 billion. Marketing, that's 2.3 billion. Chemicals and products, so their downstream, downstream, I believe it is, or chemics business, 3.3 billion. However, they had also an 8 billion cash outflow. That's why their cash flow looks a little bit less than the last quarter, like 5 billion less or 6 billion less, because they bought what was it, Spring Energy, an Indian company focused on renewables. So besides buying already back 14.5 billion in shares this year, plus another announced 4 billion in the upcoming quarter, it's 8.5 billion, which is approximately 8 to 9% of the total share count in 1 year. Yeah, just shareholder return. They're also investing in these companies, so their net debt increased by 2 billion after they reduced it year over year by 10 billion already. So they increased 2 billion because of this acquisition. I mean, I just hope that these acquisitions are also going to be cash flow powerhouses, right? I would like to really understand the return on investments in those. Like, okay, what is this already earning Shell today in incoming cash flow? But the company is doing really the right things, right? What you want them to do. They're investing for the future and rewarding us as shareholders. I mean, what do you want more?
I mean, Ben is going out on a high, isn't he? He's
Yes,
really
yes,
delivering.
yes.
He's really delivering. They're doing everything right. As we said, look, there's this transition to have. There's going to be a new CEO. Can he keep up the pace? Can he keep going? And then the transition to renewables. We're going to have to see how that plays out. But they're committed to it. They are going full throttle with it. So but you can't argue with those numbers. They are making lots of money now. We know that with the oil situation, but they're using it well. We had to suffer a little bit of pain with a dividend cut, but I think we've been more than rewarded since. So I'm quite happy. The debt increased a small bit, but no more than what it was at the
Their
start of the year.
gearing is really strong. I mean,
Yeah,
they have a high premium balance sheet at the moment. They can easily
yeah,
do this easily.
yeah. So I mean, look, top quality. They've done us well since we started this Dividend Talk podcast. I think we pioneered them from the start, but it's encouraging to see, and I'm just looking forward to seeing the transition to renewable, and I'm also looking forward to this new CEO coming in and seeing how that changes over time.
Yeah, but 15% dividend hike.
Wow.
It's already my biggest dividend payer. Yeah, so this 15% will make up for all these small dividend hikes that we've been seeing of 2%, 4%, 5%. Well, just in one go, like.
Yeah, I
Yeah,
mean, I'm sick of looking at the likes of Visa and some of these low yielding companies giving us big hikes. I want high yielding companies, and now we have Shell giving us what we want. So it's
exactly.
15%. 15%. That's what, 1.5 times inflation in Germany. I mean, everyone in
Yeah,
Germany start investing in Shell. Come on.
yeah, exactly. Good one. Yeah, I'm really happy with the numbers. Of course, we are also on a high in the cycle, so probably some listeners will say that here. That's true, but I think that's why they've been doing share buybacks now, cash return, and strengthening the balance sheet. They have a really clear capital allocation strategy, and they're just committed to this, doing it. And in the next cycle, when it comes down, there will be again opportunities. I think it's not needed to buy them now at 28, 29 euros. I'm sure in the next oil glut, it will be back at 20 somewhere. So if you have patience, you don't need to own Shell now.
Cool. And the next one on our list is Texas Instruments, this lovely little calculator company. Um, I mean, I know you did more work on this than me, but just looking at the headline numbers here, increased revenue 1%, which is 13% from last quarter. So which is quite interesting. They have said that they have experienced weakness in the personal electronics industry, and I think we've seen that kind of all over, not just
Microsoft as well, right? Their
yeah.
OEM business declined by God knows how many percent.
And that's due to a couple of things. I know during COVID that went exponentially high because people were cooped up inside, and that had to balance out. And then we balanced that out with interest rates and inflation and all this good stuff and recessions. And people obviously they are normally one of the first things that they pull back on. So you can understand that bit.
Yeah, and usually you can, in all honesty, if you we had all cash left in COVID, right? So we thought, okay, let's buy a laptop. Yeah. Also,
yeah,
we had to move to inside, so it was also nice momentum, also to talk with your boss. But really, in a recession, what do? You just postpone this decision to buy a laptop with a year. If you need one, you just install like a memory space cleaner or something like that, and you sit out another few months.
exactly. So you can see it will come from a high base, and then with the expected
Yeah.
market, I wouldn't be too concerned with that. But then you look at the cash flow from operations; it is 9 billion. 12 months ago, during the same period, it was 5.9 billion. I mean, look at that growth. That is insane. That is
Yeah, you're talking about the 9 months, right?
9 months.
Trailing
Yeah,
9 months. Yeah, and then just because they had a bit of an issue with the inventory buildup, right, in one of the last quarters, but this quarter they are totally back in awesome cash flows, almost 2 billion free cash flow just in a single quarter. I mean, this is just really, really good. So it really just delivers. They also did some 1 billion of stock repurchases this
yeah,
quarter. So I mean, they've been actually they've leveraged their whole free cash flow to pay us dividends and do stock repurchases. So for me, Texas Instruments delivered really nicely. I understand that the price was nicely holding up, and I really think it's it's nicely priced. This is the company now where you need to look at high quality business is a fair price. It's really
yeah.
hard to get this one at a discount. Really hard.
I mean, if we haven't got a discount yet, it's hard to see it. It's annoyingly held its ground, but it just shows what a top quality company it is. It's
Mhm.
managed very well. We've had a dividend hike, quite a high dividend hike recently as
Yeah,
well.
yeah,
And just look at those dividends paid and stock repurchases. I mean, they're returning a lot of value to us shareholders. So you're right. And do you know what? That's the struggle. That's the struggle because they haven't dropped in price. And you look at everything that's dropped, and you get kind of anchored, don't you? You're waiting for it
yeah.
to drop. Whereas you need to, well, I need to try and break that psychology and say, top quality company, insane numbers, pretty solid balance sheet. I just need to buy and a fair, as you said, and a fair price. So I need to get out of that psyche and just make the purchases.
I think I would agree. I have now already a little bit of a meaningful position, I would say. So I'm happy with it, but I could definitely have more. Definitely. Yeah.
So hey, there's been so much going on this quarter. Especially this week. There's a lot going on. I nearly forgot about Unilever, and I'm glad you have them there because I completely forgot. But how are these guys doing?
Unilever actually did well. But what you do need to know is so their sales growth. By the way, they don't give earnings, right? They give only a trading update in the first quarter and the third quarter of the year because
Yeah,
they are looking at this as they want long-term investors and they don't want to be on a quarterly basis evaluated, right? We can have a long discussion about that, whether that's something we want or not. Being long-term investors as well, I think our curiosity wants us to see the cash flow numbers now today already. Yeah, specifically because I have low trust in Ellen Yopi. So sales growth is 10.6%, what they say, mainly because of 12.5% price growth. So, just increasing the prices of the products, and therefore
yeah,
volumes declined by 1.6%. And you need to know that I was listening to the earnings call, and this Ellen Yopi is really proud, saying like this, how we did. But then the other day I went to the shop and I use X, for the X effect. It's always helps when you go out, the women, fall into your hands. But I know the prices a year ago and now it's almost 30 to 50% up. Just the X deodorant. So I struggle buying this, right? Maybe I should just pray a little bit less to to still get the same value for money out of it. And sorry to my friends if I will be more smelly going forward. But that's really what I observed. So the billion dollar brands, those are outperforming the other brands at the moment, and it shows how strong those brands are, because that's where the true power of the pricing power is for this company, and that's what we've been seeing here. They also did and this is where I'm really, really annoyed, and that's why also again I want Ellen Yopi out as quick as possible. They did a 750 million share buyback announcement, but they kept the quarterly interim dividend flat. So, which effectively means that they didn't grow their dividend now, and it's breaking the growth streak record. So, from an American point of view, you would say it's losing its dividend aristocrat status, because the last time they had that they remained their dividend flat was in 1995. So we're talking about after 26, 27 years, the first, pattern broken again. What is good though, and this is what I would like all shareholders to understand, is that since the Second World War, they had one time a dividend cut of 1%. This 1 cent, which was a 3% dividend cut, it was done by Sir Hartog. He was chairman of Unilever in 1966, and he was the only post-war chairman to truly cut the dividend. Ellen Yopi hasn't done it yet, so it could be worse, right? What is also good to know is that there were 6 times in the last 11 crises or recessions that they kept their dividend flat. So it does sound to be an ABC out of their, recession playbook or something like that for Unilever.
Why in God's name would you reduce your dividend by 1 cent? What? Why would you even bother? I mean, but I agree with you. It was an interim dividend. It's not the final dividend, so there is still time for him to maybe increase the final dividend if things play out. But
it's just bloody annoying me, because he should know this. We tagged him on Twitter several times with our Twitter post. I'm sure he's reading those, or his assistants. So he should be aware. He can't hide behind it anymore. And secondly,
but maybe he's thinking a little bit like you from a consumer perspective, where you're going into that store and yes, we've seen growth because they've increased prices, but volumes are down. So maybe they're anticipating, okay, volumes will continue to go down, and he's just anticipating that, so he's keeping it flat as a measure. You maybe understand that.
I think more that there's a woke culture, and he's sensitive to that, because if you watch his YouTube videos, which are not about investing, he's overly woke and responding to this. So I think the last thing he wants is during a recession to say that he's hiking the dividend and letting shareholders benefit. I think this is really the pressure to the company, which therefore is more stakeholder friendly, not shareholder friendly. I like the model, but I feel like stakeholders are being treated better at the moment than shareholders.
Cool.
Maybe just the last fact. The last time they froze their dividend was in 1995, as I mentioned. But afterwards, they had a 12.7% hike, and the year after that, a 27.8% hike. How cool would it be if the new CEO would do this for us?
Oh, I don't know if they will. It's quite high, but it would be pretty awesome. Cool. We can't talk about Unilever without talking about Danone, or Danone, whichever way you want to pronounce it. Similar to Unilever, they only give a sales update. They don't give you the full set of accounts, the full data. But let's have a little look and see. So their net sales were up 19.1%. Or they like to do it on a like-for-like basis, which is 9.5%. So a lot of that is down to their price, which again is up 11%. So we've seen both Unilever and now Danone managing to pass on their inflation to the customers, which is good for them, not good for our customers. Accelerated sales in all areas, so 11.2% in America, 6% in Europe. I actually thought Europe might be a little bit stronger because I know they struggle a little bit. China is still going quite well, 6.8%, and the rest of the world, 13.6%. They have also updated their guidance for the rest of the year, so they're expecting like-for-like net sales growth between 7 and 8%, which is up from 5 to 6%. So look, overall solid growth. We can see they're passing on their inflation. There is some issues with Russia, but that's only like 0.2, 0.3%. It's not impacting them at all. China, I'm quite surprised it did so well because I know China had lockdowns and stuff, which impacted a lot of
Yeah.
businesses. Nice to see them do well there. And I would like to see a little bit more growth in Europe as well, even though
Yeah, and
6% is fine.
again, these are sales numbers, right? And we
Yes.
know
Yeah.
they often more struggle with the earnings and the cash flows. I mean, first of all, we have a new CEO here since last year. He had his first full cycle now, 1 year. Honestly, I like what I'm seeing so far. They really gave back power to the business units in the regions. And I've been looking over the quarters and also the half year report. I can really see progression there. But it's hard to judge him now before we see the full year numbers, right? And what the real earnings are. So I'm becoming slightly optimistic about Danone again after the predecessor screwed it up. So yeah, that's it. We can't do. We don't know much more than a trading update, right? That's the issue here.
Yeah. It's annoying in one sense, but I kind of agree with the sentiment. I spoke to some of my friends in the US about this because I have to do some writing, as you know, for sure, Dividend, and sometimes I have to write about companies that only give sales updates, and sometimes it's quite annoying. But they actually think the opposite because they're so used to quarterly. They think maybe you don't need to know all the numbers all the time, and that you make rash, and you see that you do rash decisions can be made based on 1 quarter, whereas if it's stretched out to 6 months and half a year, you have less chances to make rash decisions. So I can understand it. We are long-term investors. We should not be focused on a 3-month period, but we still like that. I think we're spoiled, aren't we? We are spoiled. We just
Yeah,
like
we
to have
are.
that taken.
Yeah. So maybe then let's move a bit back to America, because how can we not talk about Intel? Yeah. And we know that Intel always drops 10% in price, but this time it went 10% up after earnings. So
Wow.
I think there was so much crap priced into the stock that we probably saw something like a short squeeze or something like that, just a small one. But we're a Dividend Talk. We study our stuff, so let's look at the facts. GAAP revenue, 15.3 billion in this quarter, down 20% year over year. Or non-GAAP revenue, what they also measure, is 15% down year over year, but 20% is a lot. However, we have mentioned often in the show, we know, and also Pat Gelsinger, when he came in, he already announced that they will be cash flow negative, for 1 or 2 years. So always, if you go back to my YouTube video about Intel or something like that, I've modeled with that we will have a cash flow negative year, 2 years, and then it will go back once the fabs come online.
Yeah.
At the same time, laser focused is the word that we saw in all the announcements this quarter. It's like everyone is laser focused. And Pat Gelsinger also all the time laser focused. But what they did, 3 billion in cost reductions will come up in 2023. This is a lot. So they're really starting to cut, and I think we will see the first people there being maybe not the first, but a second wave of people being sent off. But all in all, earnings per share 25 cents. So it's not a lot, but okay, we knew this. Mobileye was spun off. They did well with that, but I still don't like it as a shareholder. I didn't get shares for it in return, so it's more like it goes to the balance sheet. And they are revising their full year revenue guidance to 63 billion from 64 billion. So a small decline. But if you then look at the business unit revenues and the trends, data center and AI was the big one with 27% decline, but also client computing group 70% down. So these are huge numbers, right? And we knew it. It was, and I guess that's why you see the price responding like this. That people thought like, okay, no other surprises, because that's what was with Intel so far, right?
Yeah.
And also, Pat Gelsinger did this kitchen sink quarter last quarter. He said, this is the worst. Yeah, it will be better going forward. He is just building credibility at the moment right now with a CEO. As a CEO, he's building credibility with this. Yeah, that he's not fooling us.
Yeah. I mean, there's nothing really surprising here. As you said, everything was priced in. But now Pat is nearly halfway through. We said give him 2 years, judge him after 2
Yeah.
years. He's nearly halfway through that. So you do want to see him to start turning a corner and start to seeing, okay, where this company is heading. I think he's doing a decent job, but as we said, it's a turnaround play. We mention this all the time
Yeah.
on the show. People keep asking us, what's the turnaround play? How much should we have in a portfolio? But
Less
there
than
is risk.
10%, guys. Less than
Yeah.
10%.
There is risks here. There are competitors there. They have to do a lot to try and catch up to what they've lost to gain market share, but they do generate a lot of cash flow. The dividends are more than safe. Pat seems to be the right man for the job. He's an engineer. He's knows the company inside out. He was there back in the 90s when it was good. I think he rose to the ranks quite quickly there. So I think he knows what he's doing. I just think he needs the next year, and then we can properly judge him, and then we'll see if we're right.
And maybe good to highlight, while all this is happening with Intel, right, the balance sheet is still rock solid.
Yes, yes.
If you look at the increase of debt compared to equity, it's hardly neglectable. Yeah, we're talking about 3 or 4 billion year over year of increased debt, but also, all this debt is also going into property, plant, and equipment because they are building stuff for this. So their balance sheet remains rock solid, and that is actually probably the most impressive part here right now. Why I also have quite some confidence, because they are effectively just buying their earnings with building these fabs. Yeah. So I mean, that's where the positive part comes in. It's of course not good to see these revenue declines in their core businesses, right? So I really, really hope that these factories come online to generate cash flows, so that they can really get the designs right for the next the next wave of new technology, let's say.
Okay, all eyes on next dividend date. We'll see how they go. Last up on the list is Coca-Cola. We know this is one of Eli Snowball's favorite companies. We've had Eli on the show actually, but now we're starting to see pretty good results from these guys. I did mention back, I think I sold them back in 2020. I did mention that we could maybe wait 1 or 2 years. I don't think the price will change a whole lot. The price is nearly bang on the exact same as what it was in February 2020. So they've traded within that range that I quite expected, but they are starting to interest me a little bit more now. Now that they've finished their restructuring, we're starting to see what they're a little bit about. Net revenues grew 10%, 16% organic revenue, and then they had a 12% growth in price mix. I didn't even notice that had gone up, but they're obviously passing it on somewhere. Earnings per share grew 14%, and they're gaining market share. We know that they're targeting this non-alcoholic, ready-to-drink beverages, so they're gaining market share rapidly there as well. And their free cash flow, it was 7.3 billion. Now, this is a decline on last year, but last year they had favorable benefits around working capital. So it's actually not as bad as it may sound. What I did find interesting was that we spoke about how they are passing on inflation to their customers, 12%, but they've also launched this value bundle. And I don't know how they've done both. I don't know how you pass on prices and then launch a value bundle, but around this, pretty much in North America, that this bundle with or kind of sparkling brands, Coca-Cola, all this kind of stuff, where they bundle all stuff together to make it cheaper on the consumer. They must be making more money out of it somehow, but it's quite interesting to see them. They know that we're hitting into a recession. A lot of people will reduce their sugary intakes, maybe the big brands in these, so they're trying to target that. They did mention Russia in their earnings. Has pretty much a negligible impact. I think it's like 1% impact, so it doesn't have a huge impact on them whatsoever. What I did like is that they are reducing their long-term debt. As I said, they went through a phase there of restructuring, which is now done. And one thing that caught my eye on their balance sheet was trademark with indefinite lives, and that decreased by 1 billion. That made me chuckle. I was there. What happened? Did they lose a life, or what happened? But I mean, overall, quite strong. That balance sheet looks good now, and they're navigating through these times quite well. So it looks like it's tempting me. They're starting to tempt me again. They're in around that price they were 2 years ago. I know they dropped during COVID, but I'm starting to see they could be a good investment again.
Yeah. Yeah, I like. I mean, I like the products, Coca-Cola. I like Pepsi, of course, as a Coke less, but the chips more.
Yeah,
It's always this comparison, right? How can you talk about Coca-Cola without talking about Pepsi? But it's nice to see, because this company has been trading sideways for quite some time now, and seems that the earnings are catching up with the share price now, so that it becomes like, maybe an opportunity again at a certain moment. I think it's yielding 2.9% now, trading at $60. I believe it was trading not too long ago at $55. $55, you will probably get a 3.2% yield. Would be for me a nicer entry position for a slow grower like Coca-Cola. Yeah, nice one.
Yeah, but it's just nice to see them. I mean, they had a long-term plan, didn't they? And that they came off the back of that at the worst time possible. They had just finished all the restructuring, all those outgoing costs, and bam, we hit COVID, and it hit them hard. I did say at that time I'd like to see them in 2 years' time and see where they're really at. Bam, we went into a recession, but I think they're in a stronger position than they were maybe 3 or 4 years ago. So it's nice to see.
Nice one. Good. Hey, with all these earnings, look, we discussed, what is it, 7 stocks here or 8, and we didn't touch on Microsoft, we didn't touch on Visa, we didn't touch on BASF, we didn't do ExxonMobil, we didn't do Chevron, we didn't do McDonald's. It's impossible in the show. We will be still talking here tomorrow after this week, right? So, yeah, it was good to talk a little bit and zoom these out. I think also some people are interested in Danone at the moment where we are. People are also asking about analysis. I will do an analysis probably again with the year results, because I need to see the cash flow numbers to do anything meaningful. But yeah, this is it. Next week, another week of earnings again. So I'll look into that again. I'm really happy with the dividend hikes as well at the moment. But maybe now is the right time then to go to one of our portfolio reviews, because BT05, one of our Twitter followers, reached out to me and he just wanted to share his portfolio with me. And his top 10 is comprised out of Nestle, Roche, Deutsche Post, BASF, Total Energy, Intel, Microsoft, Procter & Gamble, Inditex, I believe that's the owner of Zara, and Sanofi. He didn't highlight what his strategy is. I mean, he's a dividend investor. It's also clear from the companies that he's owning. So let's assume that he wants to also, like us, at a certain moment, retire off his dividends. And then I'm just wondering, what do you think about his portfolio?
Yeah, I'm assuming these are in order as well, with Nestle being the top position. I mean, I do like the top 2, I like Nestle and Roche. What I don't like about them is they're on the Swiss exchange, and the tax is a lot more complex. It's a nice mix. I think it's a nice mix. It's definitely more European focused. It's one of the more European focused portfolios I think we've had, even compared to some of our portfolios. It is quite laser focused on Europe, to quote Pat. But I like it. There's a nice mix. He has Intel, Microsoft. You've got your healthcare with Roche. Maybe a little bit more healthcare would be nice here. And maybe some REITs. Maybe I don't see any of those there as well. But I think it's a nice portfolio. Inditex and Sanofi. Inditex is a good company. We know Phil has done a show on them before. He's wrote on my blog about them. Decent company. But I think there might be a lot of headwinds around there at the moment as well. But I like it. I like the diversification. I just don't. For me, it would be hard for Nestle and Roche with the tax situation. But all those is. But Total Energy is over Shell. Let's change that. Let's get Shell in that. I know. Normally.
Yeah, but Derek, he's not sharing his portfolio only to hear like I like it. So do you have anything to consider for him?
So for me, I would say, obviously, I mentioned REITs. I would get a little bit more diversification there. Healthcare as well, a little bit more. I know he has Rush. I would like to see some more dividend aristocrats in there that that are solid payers. Look, we have Microsoft, which is low yielding. We have Intel, which we said is a turnaround play. We also have companies like BASF, which are doing quite well now, but we know that there's risk there. And Inditex, I think there's risks around that. So I'd like to see a little bit more solid companies, some more consumer staples in there as well. Actually, that's one thing we're missing. We have Procter and Gamble, but a little bit more around that. So I would probably try and get more consumer staples, healthcare, and REITs into the portfolio. That's what I would do.
Yeah. Yeah, I have similar. First of all, I think he has a really solid top 10. These are all iconic companies that won't go away anytime soon. If these 10 companies would go all bankrupt, we will be fighting for our lives somewhere, or we will be under Chinese communistic, and then also we have issues. So first of all, that's really solid. So I really like that. And I would also say a little bit of more technology. I mean, if you think about the how I look at the world, right, and in 10 years from now, we are talking still about the digitalization of everything. Like the whole world will become more digital. So he has Microsoft and Intel. Yeah. I would still take a third company in there, like maybe Texas Instruments, yeah, or ASML. I know maybe not in the top 10 positions straight away, but then I will go for Texas Instruments. I would definitely do something like that, or an Apple. I would build around. I know that the valuation is not too easy, so that maybe is also a result of that, of where it is now. And yeah, like you, maybe some more real dividend aristocrats that you can really count on over the next 10 years. Deutsche Post, I wouldn't count on them. Here as an example. Inditex, we know they cut the dividend as well. Sanofi, I'm not really feeling comfortable about the next 10 years. Not even about Total Energies. I feel totally comfortable for the next 10 years, although they are leading the pack when you think about the energy transition. So I would focus a little bit more, maybe a little bit more American in there.
Perfect. We have no listeners' questions this week. We left it. I think we're recording this quite early, and it was too early to post it on Twitter, and we forgot last night. So we will return to that segment next week. But it's been fun. Thank you for the portfolio review. I hope it's been helpful a little bit, and we will see you all next week.